had the COVID-19 pandemic crash where there was tons of uncertainty. I mean, the economy literally froze shut, essentially. And these businesses still found ways to maneuver throughout all that chaos and still come out the other side even stronger. So it's not like we're sitting here saying like, oh, you know, the current situation that's going on is nothing to worry about. Like there's real uncertainty with the economic dynamics that are changing. It's not to discredit that. It's more to stay focused on what matters, which is, we invested in businesses. We basically hired businesses that have a great track record at adapting.
Yeah, hey, the market hustle, helping you to succeed, teaching like nobody else. Financial empowerment, giving you strategies for generational wealth, so you can start helping yourself. More money for you to be getting. This the moment for you to be winning and be living financially independent.
Market Hustle community, welcome to episode 46. My name is Josh. I'm the guy behind the Market Hustle. If you're new here, welcome to the podcast. And if you're returning, welcome back to another great episode. Today, we're going to be tackling one of the most common questions that we get from people who listen to this podcast, or even Bafi and I on Instagram alone. And that question is, what should I invest in? What the hell should I buy? It's a question that often comes up from people who are just completely new to the stock market, trying to get started, or even experienced investors who are maybe just looking to try to optimize things a little bit better. So this episode, we're going to dive into that question with some more context just to help people understand different directions, different potential directions. But most importantly, it's going to be more of a follow-up from episode 23 that we did about a year ago, where we broke down our own stock portfolios and even some of the mistakes we made along the way. So if you haven't listened to episode 23, make sure to go check out that one because that episode dives in even deeper. This episode, we're probably going to keep things a little bit more high level, but still kind of explain what we're invested in and maybe even some of the changes we've made. Before we get started, let's go ahead and check in with our co-host, see how things are going on their end. Let's start off with Bafi. Bafi, how are things going in New Jersey, man?
Man, things are great, man. The weather's getting better. I'm gonna be in Dubai next month, so just kind of really, taking April as is, having fun, enjoying life, getting outside a little bit more, working out a bit more, and then just looking forward to this Dubai trip, man. So I'll be in Dubai. I'll be in Dubai for a day or two, and then go to Saudi for about a week and change, then back to Dubai for like almost 2 weeks. So in total, I'll be in the EMEA region for 3 weeks. So anybody that's listening, if you're from that area, definitely give me the inside scoop on what to do, places to check out. And when I'm down there, you want to link up, feel free. Anybody that's traveled there before as well, feel free to let me know what the landmarks are and the best things to check out.
Man, that's awesome stuff. Yeah, you're definitely going to enjoy it out there. And I can't wait to watch your Instagram story and see everything you share with us because it's always nice to kind of see the journeys you're on, Bafi. Bafi, for a little context, Bafi's constantly traveling. He's kind of like our international travel all over the place, world tours constantly. So it's always cool to see what you're up to, Bafi, and kind of where you're at. Also, just for inspiration for like what trips we want to go on in the future as well. So good stuff. Pierce, how are things going in Southern California, man?
Sunny is per usual. Recently we've just been dealing with a house remodel. So those who knew how tedious those are, that's what I'm dealing with right now. Just uncomfortable state of the house. Other than that, can't really complain. The market's been fluctuating as it does, but I'm excited to dive into this podcast.
Good stuff, man. Yeah, those renovations are no joke. So I'm glad you're still making progress despite some of the temporary setbacks. But yeah, keep chugging along on that end. Yeah, and let's start with that. I think that's a good point, a good place to start, Pierce, with just the current market dynamics. At least at the time of the recording of this podcast, the stock market today specifically, April 3rd, we actually had one of the worst market performance days since 2020. So like in the last 5 years, we had one of the worst performing days today. The S&P 500 was down over 4%, close to 5%. We haven't had that for a while in a single day. And then the NASDAQ 100, more of the tech heavy stocks, was down over 5%, 5.4% in a single day, which is pretty crazy. And it really kind of highlights the volatility nature of the stock markets. And what I typically say is like, we've touched on it a few times in past episodes where volatility is kind of the price you have to pay to get those long-term returns that we see people talk about all the time. It's like it's kind of like the the temporary cost or the price that you have to kind of stomach to get to those long-term goals that you might have set. But yeah, nonetheless, there's still a lot of uncertainty in the markets. There's clearly a lot of fear, which is why we're seeing a lot of this selling. But I'm curious, like maybe either Boffy or Pierce, kind of like how you guys are continuing to maneuver. I know the last episode we did, episode 45, we talked a lot about fear in the markets. That was kind of towards the mid March, so to speak. So it's been about a couple of weeks since then, and I would say fear's only kind of gotten a little worse. Like it's kind of escalated. So, like, is there
Absolutely.
anything that you guys are seeing or what you're paying attention to?
Yeah, I think, as one of the things that I've recognized is great that there's more news outlet, right? More information and the access to information. But unfortunately, the negative news slash the fear, right? Like the dangers of the fear and the dangers of the tariff situations and everything like that gets pushed way more, right? I mean, the algorithm seems to feed on negativity more than positive stuff. So I think that's something I've kind of noticed quite a bit, and hopefully people realize that it's really an opportunity, And for me personally, when we get corrections and downturns and days like these, I don't pay much attention because it doesn't matter. It doesn't change much. It doesn't, in the grand scheme of things, especially as long-term investors. And if you're listening to the podcast, you definitely share those same values as well. And so I just kind of don't pay attention to much what's going on. Like I'm aware of what's happening, and I try to get like the highlights of the day or the highlights of the week. But I'm not like deep diving into it. I'm not paying attention to stuff. I'm not even reading articles. I'm not watching news. I'm none of that. I'm just living life, to be honest.
And truthfully, that's kind of the way to do it. And that'll kind of lead us. We'll jump into it a little bit more around our portfolio strategies or how we've kind of set things up. But clearly, just from Boffy alone, if this is your first time listening to a podcast episode, or maybe you're still a little bit newer in the community, you'll see that he's built a strategy that allows him to kind of take a step back and not have to worry about some of the short-term fluctuations or uncertainty, or what I tend to just call it, which is just noise, right? Like, of course, the fear is real, but market crashes or even market dips, like although you might hear people say like they're the best time to buy things, and everybody kind of let me backtrack a little bit more. Everybody wants a market dip when the market's hot, when things are going well. They're like, yeah, yeah, the next time the market crashes or the next time the market dips, I'm going in there and buying things on sale. But then the minute when that market dip actually occurs, well, a lot of people tend to get caught up in the fear itself, right? Because like these market crashes don't just happen for the hell of it. Like the market doesn't just like sit there and be like, hey, all right, I'm going to take a 5% decline real quick, and people jump in and take advantage of it. Like the reason why these market dips occur is because the fear is real. Like that uncertainty is real. And that's what naturally causes these market dips or short-term corrections or even crashes, market crashes. So we'll dive into more of the strategy or like portfolio strategy of like how people tend to rise above some of the noise or even just the fear in general by building those long-term strategies. But let's check in with Pierce a little bit as well. Like Pierce, how have things been on your end with this current market crash or correction that we're kind of experiencing?
I've been chilling, dude. I mean, like Boffy, I don't really pay attention to much of stuff. Like I'm knowledgeable about what's happening in the market dips, 1,500 points in a day or whatever it was today. It doesn't really affect my day-to-day life. I'm thankful enough to the money that I have invested. I've set aside for investing, so it does not take away from my day-to-day life, like getting food or getting gas or anything like that. But I don't really pay attention to, like you say, the noise. I mean, I'm not in this for the next 6 months, year, 2 years, 5 years, 10 years. This is a lifelong play, and I plan not to touch this money for a very long time. So, the what happens now is going to be a little blip on the radar 30 years from now. So, I'm very optimistic for the future, and I understand that a lot of people are mm, a lot of people are they're worried about like the economic, how the way the economy is right now, but it's nothing to be worried about. I mean, this stuff happens, it's historic. It's historic. I mean, you look back 10 years ago, 5 years ago, even just look at COVID. I mean, but there's market dips all the time. It's just a fluctuation, little blip on the radar.
Yeah, and I think what's important to highlight there, Pierce, is something a lot of people kind of underestimate or don't give enough credit, which is how adaptable these businesses are, especially these Fortune 500s, the S&P 500 companies, these multi-billion dollar companies. Like they're literally designed to find ways around short-term problems and extract as much profit, for those businesses. Like that's literally how they're kind of constructed. That's the skill of these businesses. So naturally, like we've seen kind of what Pierce is alluding to. Like we had the COVID-19 pandemic crash where there was tons of uncertainty. I mean, the economy literally froze shut essentially. And these businesses still found ways to maneuver throughout all that chaos and still come out the other side even stronger. So it's not like we're sitting here saying like, oh, the current situation that's going on is nothing to worry about. Like there's real uncertainty with the economic dynamics that are changing. It's not to discredit that. It's more to stay focused on what matters, which is, we invested in businesses. We basically hired businesses that have a great track record at adapting and finding ways around problems. Like that's kind of how we invest. Like that's the mindset we go into it. It's like we know as investors, especially long-term investors, that there's going to be hurdle after hurdle. There's going to be problems that come up in the future. Right now we're dealing with tariffs. Maybe in 2028, we're dealing with something completely different that people can't even imagine right now. But why we're invested in the companies we're invested in is because we believe those companies have what it takes to maneuver through those difficulties and come out the other side stronger, especially for, carrying our portfolio or the way we're kind of investing. So it's just a little bit of a reframe when it comes to what's going on now. Because I think people, it's easy to get caught up in the speculation of how things will play out or, the worst case scenario that might play out. But typically in these times, people discredit the adaptability maybe of some of the businesses that they're invested in. That's not to say short term things won't still continue to be won't still be choppy. Like that's very real. Like the market could continue to be choppy and decline over the next 6 months. But the reason why we're long term investors and we believe in having this long term philosophy is because over a 5+ year time period, your odds of profit, especially if you're in index funds like the S&P 500, are significantly higher, and they don't require you to make predictions about what's going to happen with these tariffs over the next 6 months. Like you can sit down and play the
Right.
long-term game rather than the prediction game.
Exactly, man. Josh, and to your point, like days like this is so much easier to just throw in the towel, especially if you're new to the game, right? Like you see these things happening. The whole year has been, for the most part, not super attractive or fun as an investor, right? And so, and what Josh just said is really important too, in terms of like it's easy for people to start discrediting or losing faith in the economy, in the business environment, right? Because there's a lot of pain points for everybody currently, right? And so it's easy for those negative thoughts to creep into your mind frame. And then next thing you know, right, you start going down the wrong hill and end up missing an opportunity. But I'm a big believer in also learning from the past. And this is a nice thing that many of you might be familiar with, especially if you started investing in the last like 3 to 5 years, right? Think about it this way. Warren Buffett is a great example of why you want to play the long game, right? And times like this really highlights why he is regarded as the GOAT when it comes to investing, right? Because if you think back to 2020, right, and maybe even to 2024 a bit, mainly like 2023, 2020 to 2023, right? Kathy Woods, which we all became very familiar with, right, seemed like the best and smartest investor. And I'm pretty, of course, I'm sure she has a good team and they're all very smart, hardworking folks. But in that same time frame, many people kind of laughed at Buffett, right? Or even like assumed like his long-term strategy is outdated. The world has changed, right? AI is here and like everything is just completely different. But fast forward to today, right? Buffett's company and insane. They are killing it this year. They've been killing it for the long term, and is one of the few stocks that's actually performing really, really well. And so, if you ever feel a little bit tight, a little bit uncertain, a little bit discouraged and losing faith in the market, unless Buffett decides to take all of his money and just run away and hide it under a rock, or buy gold with all of his money and just like play with it or something, you should have a pretty good faith that the economy will rebound because one is never failed to do so, and no matter what problems come in play, nations solve them, presidents and teams and national leaders figure out a way to get past them, right? CEOs, executive boards, the businesses, the employees, we all collectively figure out ways to move things forward and get things in better positions. So, yeah, just stay investing. Don't stop.
Perfectly said, man. And I would say that's probably what's really aligned between all of our investing strategies at a high level is we all three play the game of asset ownership, right? Like we are stacking assets with the goal of trying to own as many quality assets as possible. I mean, think about just the big businesses around you, or even maybe some of the big, if you have some like real estate developments around you and maybe they're owned by like these big real estate tycoons, like think about the journey that they went on to build up their portfolio. Like if they have three different multiplexes, real estate multiplexes, or even skyscrapers, like they literally might have started like 15, 20 years ago in their journey. And what they've been doing is basically playing Monopoly, where like they're just trying to acquire and own as many of the different assets as they can, which of course gets them into that position where they are, they just have a lot more options and they have a lot more wealth because of it. That's really the game at the end of the day at a high level is it's an asset ownership game. And I think if you can focus on playing that game just like you would Monopoly, it gets easier to navigate some of these short-term blips or difficulties or moments of uncertainty because if anything it helps reframe these moments as opportunities, right? Like if you're in that asset ownership mindset of trying to build wealth for yourself and your family, maybe even your future family, you're going to see moments like this as opportunities to add to your portfolio, at a discount, which is such an important mindset shift if you can get there. Of course, it's not going to happen overnight. Like it's one thing for me to say that. It's another thing for somebody to actually embody it and start practicing that mindset. But I will say, like, if you continue to think through that way or try to shift your perspective towards that way, day after day, month after month, even throughout the years to come, investing gets a hell of a lot easier. That being said, it kind of leads me to our first question to really open up the portfolio side of the podcast, which is more along the lines of what would you guys say was the hardest part of figuring out what type of investing strategy to implement? Because one thing a lot of newer investors struggle with, like even myself when I first got started, is like you start learning about the different routes to go. Like maybe you start learning about dividend investing. And like the moment you learn about that, you're like, all right, this is my path. This seems like a no-brainer. And then a month later, you might learn about value stock investing. Like you go down the Warren Buffett rabbit hole and start learning about how he picks value stocks. And then maybe like a couple months later, you start learning about growth stocks. Trying to find those heavy hitters, like those home runs potentially. So like I'm curious to learn a little bit more about your guys' early strategy, like maybe some of the struggles you had to get where
Mhm.
you're currently at. It's like both of
Yeah.
you have uh, I would say a more mature strategy at play right now, and we'll dive into that. But I'm just curious, like your journey before that, like what were some of the difficulties you had to
Yeah.
navigate?
For sure, I can definitely speak to that because I had a ton, and thank God, I have a more mature approach and responsible approach to investing now. I think the first challenge was really not knowing what to do or how to do it, right, or what strategy to even decide to go with, right. I just started off just kind of buying some stuff. Some stuff I know the name of, like companies I just know the name of or maybe use. So that's kind of how I kind of got my feet wet to begin with. And then after that, through reading some books and learning quite a bit, started a little bit more of a value investing approach, and then learned more about diversification. And so me thinking that I'm a genius, I literally built my own like diversified fund. I basically built my own S&P 500 index fund myself, right? Like it was a fun exercise and I learned a lot, right? And then I dove into dividend investing a bit more because again, that's another area of investing that I learned, and so I started implementing that strategy and then learned to lean a little bit towards growth as well. So I kind of at one point I basically had all like 4 or 5 major investing strategies at play, right? So value investing, dividend investing, blue chip investing, growth investing, right? Defensive investing. I had all of those things operating simultaneously. Now, as time went on, I then eventually leaned a lot more heavier into dividend investing, and then I reverted back to just buying, to just creating a portfolio that's more focused on index fund investing because it was already diversified and already in that situation you already have like exposure to everything you need. So I didn't have to actually like create my own. And when you create your own, you have to keep an eye on it. You have to pay attention to it. You have to make moves at times. I wanted a more hands-free, passive approach. And on top of that, I realized the more hands-free and passive your investment strategy became, the more money you actually made in doing less work. right? And so to me, that's kind of the route, the long, difficult route I took to eventually get to where I'm at today. But great lessons there. And I say all that to say that you might somebody might also be taking a difficult route, maybe or trying out different strategies, right? It doesn't mean that you're doing it wrong. Sometimes you're better off learning things the hard way because it helps you kind of recognize, okay, maybe I can use my time and resources differently and get better outcomes. So, you know, especially today, if somebody's doing like, if you're doing swing day trading, options trading, you know, having you call your puts and calls and all of these things in play, you know, some of these days in the last 2, 3 months, you're probably getting cooked, and it's okay as long as you learn that lesson well and kind of, you know, decide to take on strategies that is going to help you in the long run. So I would say, you know, keep it simple, focus on long term first, and then you can still do some of those short term activities with money that you can afford to risk. But yeah, that's essentially how I landed where I'm at. Definitely took a long route and a ton of learning.
Nice, man. No, that's an interesting journey, and I would say mine's pretty similar. We've touched on it in previous podcasts, but like I kind of went my first year, like I was trying to play like the penny stock game, where I just assumed, you know, like, oh, these stocks are like a penny, like no, they're low priced. They have the highest chance of potentially becoming the quote next Facebook or next Amazon. So like that's kind of the route I went, and you know, I would say, although you know, looking back on it, you're just like, well, duh, like why did I do that? Like that was a stupid decision. I think when you go through it and you actually put money on the line, like the lessons become more ingrained of like what not to do, or you build more clarity around the strategies that work more for you compared to somebody else. Because like I will say that's also something difficult. Is like you hear a bunch of like what other people are doing. Like you might hear on social media what Warren Buffett's doing, or you might hear on this podcast what I'm doing, or what Boffy's doing, or what Pierce is doing. But just because we're doing something doesn't necessarily mean that that's exactly what you should do. Because at the end of the day, we all are different investors with different goals. I might be investing, like my investing philosophy, a lot of them are long terms. Like I'm investing for the next 20 to 30 years. Whereas somebody who's maybe 45, 50, you know, they might be trying to retire in 10 years from now. So their investing goal is to, you know, be able to withdraw money that they invest within the next 10 years. That person's going to have a completely different investing strategy or risk tolerance compared to somebody like me who has a much longer time horizon. Or even just the foundation you're working with. Like maybe you have a high income and your skills are super transferable. It's very easy for you to take higher risk because if your income gets shut off, it's not the end of the world. Like you can find a new job fairly quickly compared to somebody who's maybe running their own business and they are more vulnerable to like 6 month down periods where income gets choppy and then it's harder for them to invest or stay continuing to invest when even the market takes a hit with their business also taking a hit, right? It's like because of just these different scenarios, it's always hard to like tell somebody what to do or what not to do. And it's partially why I call it, you know, diversification is it's much more of an art than a rigid strategy because everybody's going to have a different style. It's kind of like a career, right? Like you could tell somebody what job to potentially consider or what industry to get into, but at the end of the day, like everybody's going to kind of go down a different route. So like I think that's just something to kind of keep in mind is it's nice to learn from other people, like, and try to understand the why behind the way they're investing. But what a lot of newer investors can kind of run into trap wise is trying to just mimic what other investors are doing, whether it's Warren Buffett's, without realizing that they're just playing a completely different game. You know, like Warren Buffett, he's managing billions of dollars. He doesn't have to take these heavy hit plays. Like he's not in an aggressive growth, wealth growth style right now. He can kind of coast. Like Warren Buffett doesn't have to hit these home run after home run. You know, he can play more of these safer conservative investing plays, and he's going to do just fine because he has a portfolio of multiple billions of dollars. Compared to somebody who's maybe 20 years old, they have no wealth at all, they're starting from zero. You know, if they're playing the Warren Buffett investing strategy game, you know, they're going to be investing more of a conservative route when maybe they should be investing more aggressively for where they're at in their journey, you know, starting from ground zero. So it's just something to kind of consider. And I want to make sure we tap into that context before we fully dive in to our own strategies and kind of how we have things set up. But Pierce, I'm kind of curious as well as your end, like maybe your early journey. Were there any kind of things that caused you to question how investing kind of works, or maybe any of the strategies that you tried that didn't quite pan out the way you thought they would?
I mean, first off is like I'm very blessed to have the situation to where I did have knowledge before I started investing in the stock market. I mean, what do they call it? Paper trading. I started trading with fake money on my phone, right? And I like Boffy, I started making my own S&P and stuff like that. And I thought I was doing well, and then it did do well. I mean, historically over time, I'm sure if like I could find that account, I was in high school when I made it like 7 years ago. So if I could find that account, I'm sure it'd be profitable over time. But it's one of those things that, once I really started getting investing, the first thing I did was assess how much risk I wanted to take. When I started investing, I literally just turned 18 years old, like the day after I turned 18. And so I had to identify how much risk I'm willing to take because this is a long-term game for me. And like everybody, I'm pretty sure listening, unless it's different for every age that you're at. But right now I could take loss. So I'm more aggressive with my strategies right now. And I have been. I followed the same structure that I have for the last 5 years. And I'm a lot more aggressive than other people's, but it's because I'm young and I can take the risks. And that's one thing that I can stomach right now is seeing my portfolio down maybe a few percent more than other people's, but it's because of my age and the situation that I'm in. It works for me perfectly, so there's no reason to change it. But I never invested into any individual stocks. I don't own any individual stocks even till today. I think there's only one time in my portfolio's history that I did invest into an individual stock, and it was the only stock was it was 2.5 years ago, and it was Alibaba. But and I got lucky on that. I'm not picking individual stocks. I just happened to get lucky on that. If you look at Alibaba today, than where it was 2 years ago, I did well, but it's just one of those things. It's all risk tolerance.
Yeah, no, it really is. And that's the thing. Because like it's on one end, I feel like everybody's pretty much aware that you have to take some sort of risk to get the bigger returns in life, right? Like one mistake people make is they jump into the stock markets and they go down the diversification rabbit hole, which is good. Like diversification up to a certain point is important, but what you'll quickly realize is that there's thousands of different ways to diversify your portfolio. And so like you can get kind of lost in the weeds, like trying to find ways to just diversify, and just continue to like expand that diversification all the way to a point to where maybe you run into a different type of risk where the risk isn't losing money, but the risk is not making money, right? Like where you just kind of stay stagnant. Like that's a real risk that a lot of people don't consider, especially when they're playing that diversification game, because they'll realize that the stock market's risky, which of course there's risk involved. And that's the whole point of diversification, is to kind of help offset some of those risky plays you might be taking. But at the same time, if you are trying to avoid every risk altogether and you're just sitting there, trying to de-risk your portfolio to zero, what's the point of investing at that point? Like you're kind of defeating the purpose of investing altogether. So like it's just something to kind of consider. And I would say it's it's something that you fine tune as well, because especially during moments right now where the market is taking a dip and there's lots of fear, like it's these moments, like if you're a brand new investor, maybe you're in, 6 months into the game or even a year into the game, you can kind of audit where you're standing, like how you're feeling during these moments. Like, are you questioning these strategies that you're implementing? Are you uncertain about continuing to invest? Like, are you starting to question the consistency with investing? If that's the case, then it might be time to consider diversifying more or finding a new strategy that kind of aligns with you more. Maybe you were trying stock options. You're playing the calls and puts game. It's very fun to play when the market's going up and everybody's making money. But during moments like now, it gets a little bit more challenging. So like this might be a time where you audit, like, is this something I want to continue? Or should I find something that's, more passive and kind of more my style? These moments can really expose maybe something along the lines of just understanding your own self as an investor. Because like that's so super important to do. But that being said, let's go ahead and give some context around maybe all of our portfolios kind of at a high level, how we have them kind of structured, and maybe the reasoning why and our goals with that as well. I'll go ahead and just quickly start, just kind of roll everything off. We also, again, we made an episode back in what was it, back in May of last year, episode 23, where we dived into this in more detail. And so this will be more of an update, maybe if we've made any changes since episode 23. And if you want to dive deeper, if you want to hear like the full full context of it, definitely go listen to that episode because we spent a whole hour just talking about the portfolios themselves. So I'll just go real quick as an update. Really, my whole philosophy is keeping things as simple as possible because it's easy to overcomplicate things right off the bat, especially if you go the ETF route, which if you're brand new to this episode, I want to make sure we leave some context. Like an ETF or an index fund, you can think of those as a stock that holds hundreds or maybe thousands of other stocks all within itself. So like that's what an ETF is if this is your first episode learning about that. But really, when you start learning about ETFs, you'll quickly realize that there's still thousands of different ETFs out there. And it's easy to kind of fall into the trap of wanting to pick, 7 or 8 of them. So like my philosophy is to try to avoid becoming an ETF collector and trying to kind of consolidate your portfolio as much as possible. And that's precisely kind of what I did with my own portfolio, where I have a core portfolio, which is my ETFs. Roughly 66% of that is going to be in just an S&P 500 index fund. So that's your 500 titans of the United States. They kind of run the growth of the U.S. economy. And the cool thing about these companies is they don't only operate in the United States, they also operate internationally, like all around the world. So that position gives me exposure to those 500 titans that are operating not only in the US, but also, on the global stage as well. I think last time I checked, roughly 40% of those 500 companies, the income comes from outside of the US. So in a way, you still kind of get some international exposure with those companies, which is a common misconception I think people overlook. But that's the reasoning behind that core position in my portfolio. And we do have an episode that dives into the S&P 500s much more deeply, if that's something you want to learn more into. It's around, I can't remember the exact episode name, but if you just search up the S&P 500, you'll be able to find that episode where we dive into that deeper. So that's my core position. My secondary position in my ETF portfolio is a NASDAQ 100 ETF. So if you've listened to episode 23, not much has changed here. These are still my 2 core positions in my ETF portfolio. And the NASDAQ 100 gives me a tech edge, right? Where I'm slightly, leaning more towards the tech exposure side of those type of companies. Like, what one thing people will typically say is like, well, Josh, there's a lot of overlap in that's those type of ETFs, right? Like there's the companies in the NASDAQ 100 are also in the S&P 500. So like, isn't there overlap there? And my answer is like, well, yeah, that's precisely the point. Like I want more exposure in those tech giants, if you will. Like kind of to Pierce's point a little bit earlier, I'm okay taking more of that aggressive play right now because I'm 29 years old and I'm not going to need access to this portfolio probably for the next 20 to 30 years. It's like these are long-term plays. And of course, that comes at a cost of higher volatility. Like right now, tech stocks are getting slammed. And it's like my portfolio is reflecting that. But over the years, like I realized like I have a high risk tolerance. Like it doesn't worry me. Like if anything, I want to buy more because I understand the companies that are growing not only the US economy, but also the global economy are the ones that are leaning heavily into innovation and technologies. Like that's partially why I have those as my core positions. So that's my ETF portfolio. I also have a stock portfolio, or what I call like more of my high conviction plays. And this portion of my portfolio, it's mostly individual stocks. I do have a little bit of exposure to some crypto and some private equity companies that I was able to invest in, but most of them are just individual stocks. And this portion of my portfolio actually has grown compared to our last episode, just due to a few of the stocks that have luckily, significantly outperformed. And that portfolio was designed in a way to where, if you listen to the previous episode, it was only like 15% of my entire portfolio. Right now, it's sitting at about 25% due to those stocks that have actually grown over the last year. And the reason I started that portfolio a year ago, I've started it quite a lot more than a year ago, but when I talked about it a year ago, was I'm okay with this portfolio potentially going to zero. It's designed for those asymmetric plays, right? Where like I'm looking for those plays where, the companies I'm researching, the companies I'm deeply involved in, and I want to take more of a high concentrated play in them. They're more high conviction, if you will. So like that's how that portfolio is designed, and luckily it's done well. I'm under the philosophy that I'm going to let my winners run. So like I'm still letting that portfolio do its thing. But at a high level, not much has really changed with my strategy compared to a year ago. I'm still investing the same heavily into the two ETFs, the S&P 500 as the core, the Nasdaq 100 as my secondary position, and then as well as I have the individual stock portfolio to top it off. And I think one thing to highlight, and we can tackle this after we jump into Boffy and Pierce's question or their portfolio update as well. But one thing to highlight is that your strategy might evolve. Like I can definitely see myself evolving my strategy maybe the next 10 to 15 years, where I might not be as heavily concentrated in more of the growth aggressive plays. Like I'm still considering, what how I want to evolve my portfolio when I'm in my 30s or 40s. Like there's a lot of different options I could go. But I think that's one thing to highlight is like the way you have your portfolio set up maybe in your 20s or 30s might not be how you have it set up in your 40s or 50s, right? Like there's going to be times where you might make switches or changes in how you structure your portfolio, and that's completely fine, right? Like that's if you're not making changes, well, hopefully you're in a strategy that kind of lets your portfolio continue to grow without you having to do much. But I would say one of the best things you could do as an investor is to adapt based on kind of where you're at in your life, right? Like maybe you start a family. Maybe some circumstances occur to where you have to like slow down your investing or maybe take less risk. Like you don't want to get married to the way you're setting up your portfolio now because things change, right? Like right now, I'm grateful and I'm blessed to be able to invest in a way where I can invest aggressively, right? Where maybe in the future that might not be the case, especially as I get older or, God forbid, health issues or whatnot. Like there might be times where I have to start digging into my portfolio. And that would require a kind of a different portfolio setup to make it a little bit more stable, less susceptible to those volatility or the ups and downs once you start kind of withdrawing from things. So I guess the point I just want to make is, the way I have things set up right now, it works for where I'm at in my life currently and how things are going, but it might be completely different 10 years from now. And that's something I'm completely fine with. But that's all from me. Bafi.
Dude, that's a nice breakdown, man. Shoot, like that's fire. Like you didn't just give us like your percentages and what you own, but what they're about, what they're designed, and why you own them, right? Like you can speak to the fact that you've done your homework, you're taking strategies that work for you versus just what you heard about online or what Warren Buffett is doing, and so you just decided to do whatever. So that shows that growth, that learning mindset, right? And that's what some of the things we try to highlight here in this podcast. All right, I guess I'll touch on mine a little bit. I know I'm getting cooked today, which is an amazing thing. Some might not think so, but I'm super excited. I'm hoping it continues going down. But currently, my portfolio I have is structured still similar to what it was in the early episode that we did when we kind of broke it down. So not much has changed there. So it's still around 75% index funds slash ETFs, and then still 25% individual stocks. Now, my ultimate goal is really to get to 90% index slash ETFs and 10% individual stocks. And that's part of the reason why I've also adopted the strategy of not buying individual stocks currently. Even though the market is on sale, right? Stocks are down. Some people might be loading up on individual stocks. For me, that's not part of my strategy at this particular point in time, and that is okay, right? Like you don't have to do what everything and everybody's doing, and not every opportunity is right for you at all times. So quick breakdown of like my index slash ETF section of the portfolio, and I'll go in the order of like the biggest percentage to the lowest percentage, right? So kicking it off, we have VGT, which is a Vanguard Growth ETF. Is a Vanguard technology ETF. So it's literally 100% technology, right? So when you think of tech and you think about the top 10 tech companies, they make up like 60% of it. So is everything else is also tech in there. So that holds 18%. Next, I have VUG. That is a Vanguard Growth ETF. Big fan of it. It holds 14%. And as you can see, tech is also going to be very heavy in there. Tech is about 50% of it. And then you have other industries that make up the rest. And then I have IWF, which is iShares Russell 1000 Growth ETF. And that is 13% of the portfolio. Again, tech heavy, nearly 50% in tech. As you can see, I have a very aggressive portfolio, even when it comes to my indexes. Following that, I have MGK, not Machine Gun Kelly, but this one is about 11% of the portfolio, and it's also tech heavy. It's 52% tech, rest made up of everything else. And then VOO, which is the world famous darling that everybody is very fond of and familiar with. That holds only 10% of the portfolio. And that's the S&P 500 that Josh spoke about a little bit earlier. And then lastly, I have my ultra aggressive high octane semiconductor ETF, and ticker symbol is SOXX, and it's an iShares semiconductor ETF that holds 7% of the portfolio. Again, 100% technology, and is heavily influenced by the semiconductor space, the chip makers. So it's almost 60% of his assets come from companies that really make all the softwares, the systems, the infrastructure, the AI models, the chips, anything of that nature that we all leverage and use today in our everyday lives. So that sums up my ETFs. As you can see, I have a more aggressive portfolio because one, I can comfortably handle the volatility there, and it tends to provide above average gains. Um, but don't get me wrong, I make sure that I factor in risk as well, right? And that's why you can see I've kind of spoken about six different um, index funds slash ETFs, and they're all already within themselves well diversified. And of course, some of them do cross, similar to what Josh said. Is I do want to double down sometimes. I do want to get uh, um, like have my cake and eat it too across the board. But again, I do diversify because as much as you want your portfolio to grow, you also want it to hold up nice, right? Because you want to have a good foundation in place, so it doesn't all fall apart on you when you get days like this, or we get difficult recession periods. Because um, the reason why you got to be careful too is like for most people, especially if you're new to the market, if the market is down, let's say 10%, but your portfolio is down like 40%, you have to kind of make sure you understand what risk you're taking and that you can actually afford to take that risk, right? Because you could be in big trouble. I'm not saying you are, but you could be in big trouble. Because in that same scenario, if the market is down 20%, then your portfolio is going to be down basically at least 80%. And not many people can stomach seeing that, especially if they're new to the game again, right? So I designed my portfolio to weather these downturns a bit, even though my funds are generally aggressive. I do enjoy how I have it set it up. So that covers the 75% portion. Now let's talk about the 25% individual stocks. So basically, I have literally the big dogs because I'm the laziest investor you're gonna find, right? Remember I said earlier, one of my strategies was I built my own like diversified fund because I was doing so much homework and research on a million companies. I no longer want to do much of that, right? I want to use my time differently. And that's why Josh was saying as time goes on, your strategy might change, right? So you got to understand that sometimes you don't want to be too married to one strategy because it can hurt you later on in different chapters that is not going to be beneficial. So for me, because I want to be a little bit more hands free, I've only picked individual stocks that I know I don't have to do the most amount of homework or constant monitoring or always looking over my shoulder to make sure that they're doing okay, right? So in that 25%, I just own the big dogs. So that's Apple, Amazon, Meta, Microsoft, Nvidia. And lastly, my risky play is really Kava, right? Before I had like over 100 individual stocks. Like I said, now I got about what, six, seven, give and take, and those are going to do incredible things. Most of my gains are going to come from my ETFs. Now, I'll give you two reasons why I want to have 90% in index slash ETFs and 10% in individual stocks. And this is more like a little bit forward thinking in terms of the strategy that I want to eventually implement once I get to that 90%, right? So this is more like, so I spoke on the current strategy and like where my head is at in terms of like the near future or like the midterm from now. So, reason why I want to have 90% index ETFs and 10% individual is because one, it would allow me to take advantage of individual stocks without them taking too much room or percentage in the portfolio, right? So it would allow me to be able to even like double down on the current individual stocks I have, or if I see something lucrative or a new company that I think is attractive and is good, I can buy that without it becoming too heavy, right? Because You also don't want your individual stocks to grow to the point where, at least in my case, I don't want individual stocks to grow to be like 30 or 40% of my portfolio. I just don't want that. I don't see the point because I already have them all in the indexes anyway, in the ETFs. So that's one reason. The second reason is that my goal is actually not to beat the market. My goal is not to do worse than the market. Everybody always want to beat it, but I kind of flipped the strategy there a little bit. My goal is to make sure that I'm not doing worse than the market. That's why I want such a big piece in ETFs and indexes. However, if I can basically guarantee or ensure that I'm not doing worse than the market, anything else that the individual stocks do is really icing on the cake, right? It can allow me to get above average returns. And because I already have an aggressive index fund, heavily centered, is gonna lean towards getting me above average returns. But I know that in the worst case scenario, I'm not gonna do worse than the market, right? So it comes with a peace of mind, diversification, a strategy that I don't have to constantly tweak or do too much about, and it'll give me room to take advantage of individual stocks, especially in downturns, recessions, corrections, and bear markets. So, yeah, man, I know that was a long spiel. I try to give a couple buckets and break it down a little bit, and space them out a little bit. But yeah, that's currently that's how these my portfolio is set up, man. Yeah, I like being aggressive.
And I think it's important, especially when you're in, like we're only going to be 20 or 30 in our 20s or 30s once, right? And it's like when you're this age, like you want, at least in my opinion, I think you should play more aggressively when you
Yeah, I want
can.
the growth.
Exactly. Go for the growth because, like,
I
compared
want the growth.
to when you're in your 40s or 50s, maybe you have a family going, or maybe you just have different, just a whole different life going on. It might be more difficult for you to take more of those risky approaches or aggressive approaches, or deal with
Yeah,
more of the or stomach more of the volatility, right? If you have like
yeah,
three
dude.
kids coming, another kid coming, you don't want to see your portfolio moving, your retirement fund moving 10,
Facts.
15%, compared to when you're in
Facts,
your
dude.
20s or 30s, it's much easier.
Yeah, and think about it this way too, right? As you grow older, your time becomes even more precious, right? It's not a resource that you want to spend looking at certain things or having to do research 24/7, right? Especially if like Josh said, if you have another baby coming or you're a family man, right? You're married and stuff like that. You want to spend those quality times with your family. And the best way you can do that is to have an investment strategy that you don't have to constantly pay attention to, right? Because you can buy back your time and then spend that quality time with your family. You don't want your kids growing up without you. You don't want your partner feeling lonely. You don't want to live a family life where it's lacking experience, it's lacking excitement, and it seems like your number one priority or all you care about is money, right? Versus the things that money can't buy that you already have, which for the most part is the pinnacle of life success and fulfillment, man. Having good relationships, having together. So,
Yeah.
part of my strategy is also, heavily related to just those sentimental values and those priorities, and knowing that, hey, I don't want to have to sit at the screen every day. I want to be able to just spend time with my family, and even if my portfolio is down a little bit, I don't got to really worry about it or sweat it. Um, and then also, it just comes down to, especially the younger you are, the more aggressive you might want to be. Like Josh said, you want to go after that growth, right? Because for the most part, if generally most of us are going to be married and have kids, right? From 35 going, those responsibilities kind of start piling up. So if you're investing now when you're 20, realistically, you might have a good 15 to 20 years to kind of pump a little bit heavier, right? In terms of your resources can go towards the market more versus when you have kids, when you have mortgage, when you have education, when you have to kind of extracurricular stuff, put them in sports, right? Things that they're passionate about. You want to be able to do those things. So for me, when you're young, yeah, you want to be a little bit more aggressive, but be reasonable and be responsible, right? And that's where diversification comes in. So yeah,
Yeah.
invest based on life. That's something we always preach on here for sure. If you do that, you're gonna do fine.
Yeah, definitely be smart about it when it comes to the risk side. But at the same time, if you make mistakes in your 20s, it's a lot easier to recover, in your 30s or
Good point.
40s compared to if you're making those mistakes in your 40s, you're
Good
already
point.
kind of running up where you don't want to make major mistakes that blow you out of the game when you're in your 40s or 50s, right? Where it's easy to recover from those, maybe if you make them in your 20s or early 30s.
Yeah, and to be honest, I love the market, but I'm lazy. As I've gotten older, I've become a more of a lazier investor. After work, the last thing I want to do is go do research, dude. That's like another job in of itself, man. Right? So it's like when I get free time, that's not what I want to think about or feel like I have to do something in order for my portfolio to do well. You know what I mean? So I like to set it and forget it.
Good stuff, man. What great breakdown, Boffy. Thanks for sharing all of that.
Thank you, man. I'm excited to hear Pierce, man, because Pierce is at a different age and stage, and so I want to see how he's thinking through his strategy there a bit.
Yeah, and I know he has a different strategy compared to us from the last episode last year when we did that. So
For
yeah,
sure.
let's hear it, Pierce. What do you got to share?
And
Okay,
it seems like it's been paying off too, so that's cool.
it has. I actually lied to everybody, and I apologize. I do own another individual stock, so I do apologize for that. I said I didn't, but I did. Um, so 86% of my portfolio right now is in equities. I have 8.42% in taxable bonds, and I have 4% in cash just for, the oh shit moments. But we'll break this down, simple stuff. Um, I'm largely invested in, m most Vanguard stocks. So like the S&P Trust, the equal weight index funds for, Vanguard 500, high yield. And like Boffy, I'm in some semiconductor ETFs. And the one individual stock I do have is in NVIDIA. But I mean, I have RSP, which is it's exposure to all the huge United States companies, and it's not super risky. It's mostly growth oriented. Like I'm not invested in not as risk. It's not as risky as individual stocks. I'm in SPY. I'm in VFH. I'm in SMH, which is a semiconductor. Nvidia, which makes up 7.3% of my portfolio, because I bought it when it was a little bit lower, thankfully. And so just for some more safe things, I am in like, short-term bonds and, some dividend ones, but it has changed a little bit since last year. Because last year was I had it structured very, very safely, like I was ready to retire. And I realized, hey, like, yeah, I'm not, I'm not even freaking close. The retirement's not even in my eyesight. So, and my strategy, it's diversified. It's a safe bet, and it's something that it will work. I know it will work over the next 10 to 15 years, and it'll make me a whole bunch of gains, which I'm excited for. But some of my assets do include, I'm a very big guy into precious metals. And Josh, Boffy, and I were just texting about this a couple of days ago. So, it's the precious metals are, the universal currency, gold to silver, we used to be on the gold standard for a reason. And so that's another thing as different diversification. If you're not into real estate and stuff like that, if you don't have the money for real estate, you can get the money to go maybe buy some precious metals, or if you don't want the actual precious metals, you can get, the futures for it, silver futures, gold futures. My portfolio is pretty slim right now. I mean, dude, I'm not invested in too many things, but it's proven to work, and it's been working for me over the last 9 months of how since I structured this portfolio. But there's one thing I do want to make sure everybody understands is just have enough money. I what was my cash percentage? It was like 6%. I don't remember, but I have a certain percentage to set aside for the oh shit moments. So if something dips, I can just buy more. So always have cash in your portfolio for like the moments that you don't have to sell a stock, that you just have the ability just to go buy a stock. So my stuff's pretty easy. I mean, if anyone has any questions, just DM me, and I'm open. I'm not here to say numbers, but I'm open to show you how I have my portfolio structured. But that's pretty much where it's sitting right
No,
now.
that's
It's
cool, man.
simple but
That's
proven.
fire, man. It seems like a solid balance and manageable in a way that fits you, right? Like, and I think
I don't have to worry,
that's
bro. I could chill.
yeah, that's one of the most important things when it comes to investing, and I can see why it's so difficult for a lot of people to figure out. All right, so if you're somebody who just started investing, whether it's last year or this year, and you don't kind of know your identity in terms of your strategy for investing yet, it's okay because you might have to be in the market for some years to figure out all these pieces out. You know what I mean? And so that leads me to ask Pierce a question about his strategy. And one of the things that stood out to me when he was kind of telling us about how he has his portfolio set up is, he mentioned the taxable bond that he has, and I'm curious to know the strategy behind that taxable bond, Pierce.
So there's quite a few reasons, and correct me if I am wrong, but the it's backed by the United States government, and there's one thing that I do not trust, and that's the United States government. Yet I have a whole shitload of money in the United States government. But the way I look at it is, if something were to go wrong, like companies could get hit and stuff like that, and governments get hit, and shit happens, man. It really does. But for me, it's a safe bet, and there's a significant amount of money in there. And so for me, it's more of a safe play. And this is money that I do plan on touching sometime soon. This is for, for a property for myself. So this is something that's more, I don't really care about I looked at it. There was a couple portfolios that I was describing when I was mentioning this, but this one in particular is one that I am looking to use for property for myself, in the near future, my first home. And so it's stability, it's safety. And then another reason is because I live in California, and so it's exempt from state taxes and local taxes. And so it's when I do pull that money, it's a lot of money for me to be pulling at one time that I would have to pay a shit ton of gains on. And so that's one of the reasons that I do have it structured for that particular thing. That money is set aside for property. And it was in some different stocks beforehand, some different ETFs and mutual funds. So I did transition that money from I did 1031 on the stock market. I moved from here to here, and so that's kind of what I did. But that's basically the main reason, is because it's going to be used for me to, buy a property in the near future. Haven't decided when, not really in a
Right.
rush, but it's,
That's
it's backed by the government. If shit happens, if the
right.
government falls, bro, we're all cooked.
No, that's smart, man, because that's one you typically don't hear a lot about, right?
Yeah.
Most of the time you don't hear much about bonds, or especially in this case, a taxable bond. And it seems like your strategy is actually smart because you're leveraging the growth on that,
Yeah.
and you're playing a defensive game and offense at the same time, in terms of, hey, whatever happens, you at least know that it's backed by the US government. And on top of that, the way you have it set up, you're not really going to be paying much tax. You're not really going to pay taxes on it anyway. So it's like
Yeah.
it's a win-win, and that's why the education piece, understanding the loopholes of how to move around, can be lucrative. So it's nice to kind of hear something very different than what most people may see or hear online within their strategy. So that's cool, man. Good stuff.
Thank you. Appreciate it.
Well,
Yeah.
that
Sorry about go on, Jeff.
I was gonna say, especially the strategy behind that too, like the reason or the reasoning behind that. So, good question on your end, Bafi. Because if you do plan to potentially use it to purchase a real estate property in the next couple of years, you don't want that money in aggressive plays, right? Like you don't want that money potentially being exposed to a 30-40% downturn that could occur in the short term. You want that money ready to actually deploy towards maybe these short-term goals you have of getting those real estate properties. So it sounds smart and thoughtful on that end, especially since it's no different really from like a CD or a high yield savings account, but the treasury bonds, like you can put the T-bills. It was a T-bill, right? Okay. Uh,
Yeah.
so
Short term, but 1 to 3 year. But yeah, it's T-bill.
Gotcha. So like, and the cool thing about those is like, there's, those are all backed by the government. So like for if whatever
Oh,
happens, you're going to get your dollars returned compared to, worst case scenario if a bank collapses, those are only FDIC insured up to $250,000, only 250,000, but like, it's still quite a bit. But nonetheless, like the T-bills just, they have no limits. Like they're easier to kind of maneuver through the system in a way. And like you said, you get that tax benefit of not getting any of those get hit with those tax bills, if you will. So cool stuff. Interesting to kind of touch on as well. I do want to leave everybody kind of listening with a few actionable tips, if you will, especially if you're early on in the stage of figuring out maybe how to build out your portfolio or figure out just to kind of gauge your own risk tolerance. Um, there are quite a bit of risk tolerance quizzes or assessments online. Like if you just Google risk tolerance questionnaire or quiz, you can find some really interesting questions or quizzes just to complete that will kind of give you more insight to what your risk tolerance might be. There's so many different ones, if you just do a quick Google search. I've also built out my own in Money Mastery. Like this is something I've been trying to focus on, is like trying to help people understand their own risk tolerance by taking these quizzes and kind of matching them to different strategies. But nonetheless, I still think the best way to learn is actually to get your feet in the water and get a feel for it. Because, taking the quizzes, it can give you some insight, but the best way to learn is to like, jump in the water. You don't have to use hundreds of thousands, you don't have to use all your money, whatever you have money sitting on the side. Like, even if it's just like $50 a week, $25 a week, just to actually get started and have some skin in the game, if you will. That's kind of the best way to kind of fill out if you are overexposed or maybe your portfolio is not quite as aggressive as you want it to be. It's really much more of an art, if you will, than it is like a rigid strategy of how to diversify your own portfolio. As you can see just from me, Pierce, and Bafi, we all have three very different portfolios in a way, like how we have them set up. But at a high level, like we're all still aligned with playing the asset ownership game, right? We're playing the long-term game. And that's really the most important thing. Like as long as you're owning things that pay you to own them, that's the game. Like that's the unlock right there. And that's what you want to be focused on. Because like it's easy to get lost in the details of like, should I buy this? Should I buy that? Um, Half the battle is just getting started and jumping in the water. And you can kind of, realign or restructure things down the road if you need to. Kind of like what we touched on. Like you don't have to get married to one strategy and that's the strategy you got to stick with for the rest of your life. You can change things. You can always change or shift your strategy as you learn, as you go. So, obviously, the more you can educate yourself beforehand and learn about the market and learn about different strategies is good. But at the same time, you don't want the analysis paralysis to kick in and never actually get you into the game just due to all of the different opinions and thoughts out there, because there's a hell of a lot of them, man. I guess one thing to kind of wrap up this podcast that I want to touch on real quickly is more along the lines of maybe how you guys see your portfolio potentially evolving over the next 5 to 10 years. Like I'm thinking through some things myself, and I'd love to also hear maybe your guys' thoughts of around. I know Bafi, you already touched on kind of your goal is to get more towards the 90% ETFs, index funds, and away from the individual stocks. But I'm curious to hear maybe we can start with you, Bafi. If you
Yeah.
have any other ETFs you're considering, if you're considering consolidating some or adding exposure to
Right.
different ones. Like, is there any thoughts you kind of been considering?
Yeah, so actually, yeah, but in the short term, there's not really much I'm looking to do or change or consider. The ones that I listed is basically what I'm going to own for a while, and I want to keep, piling up and just getting more quantity and number of shares. And I plan on doing that for about the next 10 years, right? My goal and strategy really there for the next 10 years is to get that portfolio to 1 million, right? And once that gets to 1 million, my strategy is to go 50% ETFs index, the other 50% dividend ETFs, right? And so I would say like the 50% that's going to remain ETFs is still going to be in the same, ETF that I mentioned earlier in the episode. However, the dividends ETF, I'm going to be adding VYM, right, which is Vanguard High Yield Dividend, SCHD, that's Charles Schwab US dividend version of that, HDV, which is another really strong dividend, and then JP Morgan Equity Income, which is JEPI. So those are the four that will make up the other 50% of the portfolio, and that will be in dividends. Because I think if I can get this portfolio to 1 million, let's say 10 years from now, it's going to be very lucrative because those my index funds ETFs that are designed to grow are going to grow the portfolio very very strongly, but I also have the flexibility and the liquidity of getting strong dividend cash at that point if I feel like I want to kind of leverage having a little bit more cash. And at that point, I don't have to fund the portfolio myself anymore anyway, because my dividends, it should be big enough to kind of really, contribute a sizable amount consistently throughout the years to come, So I think that's really kind of I would say my long-term strategy slash long-term play by 10 years from now. But it would depend on how high I can get this portfolio. That's why I'm excited about investing aggressively. That's why days like this keeps me happy, because I can double down, get more bang for my buck.
It's always interesting to just kind of hear as well, like the breakdown and your thought process of like what you're considering and the moves you're kind of planning for. And I really think it also highlights the journey of investing, right? Like, we
Yeah.
don't have it, we're the way we're currently investing isn't the final form, so to speak. Like there's
Facts. Yeah.
room to evolve and grow within our
Yeah,
portfolio.
and dude, and that can change too, right? Like it might be 10 years later, and maybe I won the lottery, and so I'm like, all right, well, it don't matter. Or or maybe 10 years later, my income, whether my business or my income, things are really, really good, where I'm like, okay, well, I don't need to really tweak the portfolio much or do anything. I can keep it just kind of doing what it's doing because maybe my income, my 9 to 5 income is really good, and I live very comfortable, or maybe I have no debt, right? Currently, I have no debt, and maybe down the road, I also have no debt, and therefore I may not need as much liquid cash to do, to pay bills and stuff like that. So,
Mhm.
I say all that to say that, like, whatever your strategy is, yes, you want to have a good strategy in place for yourself, but always remain flexible and know that as time goes on, it can change depending on your circumstances. I could be in the worst position in life 10 years from now too. Of course, nobody want to be a pessimist, but we have to understand in life it can go up and down. And so 10 years later, if life is down, I may look to strategize a little bit different as well, right? So always just leave room for flexibility, and then you do fine. Yeah.
Yeah, good point, man. Yeah, we got to make a habit to do these like at least once a year, just to give
I
kind
know,
of
it's
an update.
nice, man.
Yeah, yeah, it's
Cool.
it's cool for us to also reflect on like how things have shifted.
Yeah.
So interesting stuff. I would say for me, like one thing I could potentially pivot to, and something I've been considering is adding exposure to like an emerging market fund, like VWO is something I've thought about. And,
Yeah.
it's something
Interesting.
I'm kind of chewing on it a little bit. I would still consider that more of a potential growth play. I mean, the last 5 to 10 years hasn't, VWO hasn't done much magic performance wise, but that doesn't mean the next 5 to 10 years won't be the same. Like there's a lot of things shifting in the global stage right now, and it's just something I'm kind of considering to further diversify my portfolio, maybe in my 30s, once I hit the next decade of my life. And what's cool about VWO, it's still like I would say it risk wise, it's kind of still in the same category as like maybe even a tech play. I mean, the tech narrative has played out, right? Where it's we've seen results posted and these companies have done really well. Where VWO, it's risky because you're kind of concentrated in countries that, maybe the business environment is different. Like, for example, uh, VWO, China, like Chinese companies make up almost 40% of that fund. It's like a lot of people, I think, are aware that the Chinese economy is growing significantly. But of course, like there's still risk, especially when it comes to their business environment, because it's just completely different than how the US operates business wise to that specific stock market in general. But it's just it's something I'm considering because like obviously the U.S. isn't going to we're more of a matured economy where there's other like these emerging markets that are growing much more rapidly. Like their economies are going from not developed to actually coming up to par to the US's economy. And so like there's a lot of growth options out there when it comes to other ways to kind of invest aggressively, a little bit more strategically. So it's just something I'm kind of considering, and something I could potentially pivot to maybe in the next 5 years, where I trim a little bit off the Nasdaq 100 and maybe start throwing more into an emerging markets fund, just for a little bit more diversification, as well as just a different type of growth play.
That's solid,
Smart.
dude.
Yeah, smart. I think the only other individual stock that I would maybe really consider is Berkshire Hathaway.
Oh yeah.
Yeah, that's about it. I don't think I would really like consider it a lot, and even that I kind of consider him as like as a ETF, in of his own way because he owns so many different companies within that. Um, But yeah, Pierce, what are you thinking in terms of like 10 years? I know you've been kind of dabbling in real estate a bit more and stuff like that, so
We'll
I
get
kind of
there.
want to
We'll
know
get
your
there.
what's your strategy long
Um,
term?
like Josh said, I mean, I'm a super big guy in like emerging markets. Like I do have like a giant piece of a portfolio like set to emerging markets. And like you were saying, VWO, it's 40% Chinese. It has India, it has Brazil. And the thing about these countries, coming up is that they're younger populations, so that means the wealth transfer going from these countries is going to the next generation, and so we're gonna shortly see that here, and that's one thing that I think nobody talks about, which actually like appalls me, is that most of these businesses, God bless Warren Buffett, but I mean he's old now, dude. I mean, you know,
Yeah. Now,
Like
emerging market is pretty cool too, man, because think
yeah,
about it. These environments, they got the manpower,
that's
right?
it.
Like India has manpower.
Oh
Like
hell yeah.
it's incredible, right? And you can see the way that technology and advancement is creating more synergy across the board, right? They also get to develop their economies and their infrastructure really, really solid. So yeah, I think there's a lot of lucrative opportunities that's to come from emerging markets.
You
I only
know,
have a couple. Oh, sorry, go on.
I was just going to say we should plan an episode where we break down like emerging markets in more
Yes,
detail.
I agree.
Love to.
I agree. That would be cool.
I do
We'll
have
plan for that.
a couple last things though, and this is something
Nice.
that I have been thinking of for like the maybe the last 8 to 9 months. I have some family members who are in agriculture, such as funny enough, Arizona, and so there it's a it's water, cotton, and grain, and so this is one of the things that I do want to get myself into. I don't have the funds yet to get myself into buying these things, but I want to get into real world commodities such as oil, like super heavily, because this is something that's the whole world's reliant on. I want water, I want food, I want oil, I want clean energy, and these are a couple of things that my portfolio is definitely going to get structured in maybe the next 3 to 5 years once I have the funds to do so. But I'm going to be heavily invested in maybe some of those ETFs, and then once I do have the proper funds, I'm gonna start buying like the physical land and stuff like that.
Got you. You're like Pokemon, you got to catch them all, man.
That's right, dude. Trying.
Good stuff here. Super interesting just to hear your guys, both of your thought processes and as well as just, the development of like where we've come from since that last episode we did about a year ago where we broke down our original portfolios. So I think a lot of people listening, like I'm sure everybody listening right now has learned like just different routes they could potentially consider. But I still want to highlight and just bring it all back to this. The way we're currently investing or even the potential routes we're considering, keep in mind that it's what works for us, right? Like maybe given our situation, the circumstances we're currently in, or even just the risk comfort levels we have, or the time frame that we currently have to invest,
Yeah.
like that's something I want to highlight, triple like three times on this podcast because
Yeah.
it's very easy just to assume what works for me will work for you. And I want to remind you that, first off, make sure you do your homework, but also don't fall into the trap of just copying somebody just because they seem like they know what they're doing, because although we've all done our homework and we've spent years investing in the stock market, the risk, there's still risk involved. And the risk we're currently taking is what works for us. Like it's something we're comfortable with. Like even with my like individual stock portfolio, like the reason why I'm investing in the stocks, like the way I have it set up is where if that portfolio goes to zero or gets wiped out, it's not the end of the world. Like I still have the ETF portfolio, which is designed for my long-term, retirement growth or work optional future, if you will. Like that's the main objective of that portfolio. So like, just because one person's investing a certain way, you might not understand why they have it set up that way or the risk that they're comfortable taking. And it might be completely different from something that you're comfortable with. And you won't really know that until you get in the game and feel out the volatility more. Maybe try to take some risk tolerance quizzes, go Google just to kind of take those to kind of help gauge how you might react to certain scenarios playing out, which will help just give you more insight. Because really, I think the biggest battle or the biggest thing you have to really learn in the stock market is just learn more about yourself. Like kind of like take a step back and kind of get meta where, you know, figure out how you react to certain situations or like how comfortable you are with taking risk for some potential reward, because like that's really what it is at the end of the day. And I know I'm kind of going on about this a little bit of a tangent, but I just want to make sure whatever you listened here, take it with a grain of salt and make sure to do your own research before you finalize any investing decisions. That kind of wraps that up. Bafi, do you have anything to add to that?
Yeah, just final thoughts on that. Of course, it's always important to consider your financial risk, but equally and maybe more important, consider your life risk, right? In terms of your life responsibilities, your circumstances, along with your financial obligations, because those things you have to let those things guide you in making responsible investment decisions, right? If you ignore those important priorities and then go and invest the money in the stock market, you're not just quadrupling your risk, you're like tenfolding your risk, right? This is one thing to deal with market volatility, but it's another thing to skip rent money or certain important pieces to your day-to-day living and your family day-to-day living and go put that in the market in hopes that it will grow. And then you will like, make sure that it's good. So always consider the life risk along with your financial risk and then along with your portfolio risk that you take and see what the gaps are, what the pitfalls are, what the red flags could be, and then just constantly kind of assess that over time.
100%. This was a good episode, guys. I think we went over quite a bit, and it's always nice just to kind of reflect on, the changes that we've made or even what we're considering. So this was a special episode, and we'll definitely have to break down the emerging markets episode, not only for everybody listening, but just to help all of us, combine what we research, what we know, and just, help us all grow as investors, in this whole community. So that's what it's all about. Pierce, do you have any closing thoughts on your end, man?
No, it's just no better time to get invested but now. Just do it.
That's it. Go stack those assets, man. Well, hey, Market Hustle community, that wraps up episode 46. We covered quite a bit here. If you found this episode helpful and enjoyed it, just to kind of hear different perspectives and different potential routes to construct your portfolio with, make sure to go leave us a quick 5-star review on whatever podcast platform you're using. But that is it for this episode. Episode 46 is officially wrapped up. I hope you all have a great rest of your nights, and we'll catch you back in the next episode. Have a good one. Bye-bye.
If you feel just like I do, link up, come and join this crew. Hey, I'ma go invest and I'ma watch my money double, take it to another level. With that market hustle, always play it smart. You ain't dealing with a sucker, take it to another level. With that market hustle, I'ma hustle, hustle. 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 With that market hustle, go.